Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Q2 Institutional 13F Filings and the Macroeconomic Divergence. This video presents a direct informational narration of the source document. Okay, let's dive right into this explainer and unpack a massive divergence that's currently playing out in the market between institutional filings and the underlying macroeconomic realities.
Here's our roadmap for today. We're going to start with the macro consumer data, then explore how institutions are actually rebalancing. After that, we'll look at specific mega fund moves, and finally, we'll break down Michael Burry's highly contrarian long and short positions.
Section 1. Macro Consumer Economic Data.
Let's establish our baseline here. The data points to a very clear trend. In July, retail sales fell 0.6% month over month, which significantly missed the expected 0.1% growth. And even if we exclude auto sales, that figure still dropped by 0.3%. But the real standout here is the control group. This metric strips out all those volatile categories to give us a much truer picture of underlying consumer spending tied to GDP, and it dropped 0.4% against expected growth. This illustrates a very clear, undeniable weakening in consumer spending momentum.
And this weakening, well, it's further reflected in the August Michigan Consumer Sentiment Index, which took a sharp drop down to 51. That significantly missed expectations and completely wiped out a 2-month rising trend. But what really stands out in this survey is that only 8% of consumers expect their income to outpace inflation over the next year. Honestly, that is a sobering reality.
Section 2. Institutional Rebalancing Trends.
So, how exactly is the smart money reacting to all this? When we look at 13F filings, which, as a reminder, are those mandatory quarterly reports that give us a delayed but absolutely crucial snapshot of where large institutions are actually putting their capital, a huge divergence emerges. Despite the softening consumer backdrop we just talked about, large funds are basically ignoring the macro weakness. Instead, institutional capital is highly concentrated. They are anchoring heavily to the high-growth AI and semiconductor cycles, actively chasing the rapid earnings growth and strong forward expectations found in mega-cap technology.
Section 3. Specific Megafund Q2 Moves.
Now, what's really interesting about these broad trends is how they translate into exact portfolio adjustments. Looking closely at Berkshire Hathaway, we see a noticeable shift. They added to positions like Google and the home builder DHI while gradually reducing their long-held stake in Bank of America. They also completely cleared out their position in STZ. Because of these steady adjustments over recent quarters, Google has seen a structural rise directly into Berkshire's top 5 holdings, sitting right up there alongside Apple, Bank of America, American Express, and Coca-Cola. Moving over to Renaissance Technologies, their adjustments show a really aggressive concentration of capital. They completely liquidated their broad semiconductor ETF, the SMH, and instead deployed that capital into individual mega-cap tech names. Specifically, they added to NVIDIA, Meta, and Broadcom. At the exact same time, they reduced exposure to storage-related equities like Micron and SanDisk.
We also observed this strategic repetition across funds like Bridgewater and Bailey Gifford. While many institutions did reduce their Amazon positions, this appears to be strictly for tactical rebalancing to avoid overconcentration rather than an actual loss of conviction. The common denominators across these megafunds are exceptionally clear. NVIDIA, Google, and Amazon firmly dominate their top holdings, reinforcing this massive sector concentration.
Section 4. Michael Burry's long positions. And this brilliantly illustrates the total dichotomy we're seeing right now, because Michael Burry is completely isolated from the Wall Street consensus we just reviewed. On one side, you've got institutions driving a tech melt-up, a rapid, unchecked rise in asset prices. On the other side, you have Burry's contrarian rebellion against those very same institutions, characterized by heavy short positions and a very isolated focus on specific out-of-favor long.
Categorizing Burry's scarce long positions reveals a hyper-specific strategy. His Tier 1 longs, representing roughly an 8% concentration, are entirely focused on Chinese tech stocks, Alibaba, Baidu, and JD. His Tier 2 positions show exposure to lagging equities that have underperformed, such as Lululemon, PayPal, and HCA. Finally, his Tier 3 positions include exposure to mortgage and regional grocery names like FNMA, FMCC, and SFM. Overall, his long exposure is remarkably minimal.
Furthermore, Burry has actually increased his cash position to approximately 12%.
This isn't an accident, it's an intentional, protective measure. By holding this cash, he aims to avoid margin calls on his highly leveraged portfolio, ensuring he has sufficient capital reserves to weather any market movements that might go against his positions.
Section 5. The Big Short Returns.
Let's move to the mechanics of his massive shorts and see how this all builds. First, he took profits and exited his shorts on Tesla and Meta. Next, he closed his put options on the SOXX semiconductor ETF. He then added direct short positions against Micron. But most crucially, and this is the big one, he tactically rolled his options, moving massive put positions against the Nasdaq 100 all the way out to an expiration date of June 2027.
So here is the crucial takeaway from all this data. With the broader market hovering near new highs, immense pressure is building under the surface. If the market breaches the critical 7,900 level threshold, it is poised to trigger stop losses and force short sellers into a massive covering squeeze just to protect their capital. The lingering question we leave you with based on the source document is this. If that threshold breaks, exactly how far will that forced momentum carry this market melt up before a fundamental reset finally happens?